is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Waiting on jobs, Asian equities and U.S. futures edge lower after a key inflation gauge comes in softer than forecast. The next clue on the health of the U.S. economy, of course, today's non-farm payrolls. Crisis in Cape Town while South African President Cyril Ramaphosa weighs resignation amid corruption allegations. The rand takes its worst tumble in 6 years. Plus, bank cuts, lenders start slashing bonuses and jobs. The chair of Credit Suisse exclusively tells us that outflows have stopped from the embattled lender.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Well, first thing is first, so let's check on the markets. Now, European stocks are pretty much trading sideways. There's not a huge number of news out there, apart from here and there a couple of pockets of concern. We look at OPEC Plus, of course, over the weekend. The big story is what happens with the Fed, and we have that non-farm payroll a little bit later on. We have a special show to see whether we can infer from that what the Fed does next in terms of aggression or not with interest rate hikes. Technology stocks gaining some 0.4%. The U.S. dollar index 125.4, and then Bitcoin 16,967. One of our reporters actually flew to the Bahamas to interview the FTX founder, so don't miss that interview. We'll bring you that throughout the day. European maps, this is a good indication. First of all, there is also a lot of speculation that it's going to be quite hard for an oil price cap, also a gas price cap from these European countries. You can see the FTSE down 0.4%, similar loss for the CAC 40. The FTSE, maybe in Italy, holding up a bit better, and then the DAX actually seeing a couple of gains, 0.1% higher. Now, we do have two exclusive interviews to bring you this hour. In a few minutes, we'll be joined by the South African finance minister as a scandal threatens to take down the country's President Cyril Ramaphosa. Plus, we'll also have more from my interview with the chairman of Credit Suisse, Axel Lehmann, on the bank's sweeping overhaul.
When I speak to clients, I know, that there will be inflows. We already see it partially happening. So we have plans to continue to reach out to clients. It might take a little bit of time, but it will, it will come back and we'll go back to normal.
Well, we will have more from that exclusive interview with the Credit Suisse chairman a little bit later. Now, there is a risk-off mood in markets as traders look ahead to a U.S. jobs report for clues on the Fed's rate path. Bets on the peak have now dropped below 4.9%. That's according to swap markets. We're now joined by Laura Cooper, senior macro strategist for iShares EMEA at BlackRock. Laura, always great to have you on the program, so thank you so much for coming on. U.S. jobs, non-farm payrolls, the big one. Will they change your expectations of what the Fed does?
I don't think they're going to change expectations for what the Fed does, largely because I think the Fed is going to look through it if it's a very strong print. They've already alluded to the fact that employment remains robust. If it is a downside surprise, we could actually see markets have a risk-on rally on the back of that, largely because the Fed has already kind of said that they're going to have a pause at some point. So I think for the Fed, though, they're probably going to look through the jobs data. It's quite a high bar for disappointment for them to actually change away from that 50 basis point increase in December.
Laura, what's being mispriced at the moment? So I know, and this I feel like we go through every week, if not every day, is that the market believes that the Fed is slowing down the pace of interest rate hikes. But the Fed is also saying, guys, we're going to have to hike, maybe gradually, but it's going to be painful to get where we need to be to deal with inflation.
And that really is an interesting divergence. And the market reaction that we saw on the back of Fed Chair Powell's speech on Wednesday was quite surprising because the messaging didn't really change. This is going to be a higher for longer environment, although more gradual pace, which is increasingly prudent as we get to that terminal rate. So I think in terms of what's mispriced, probably the terminal rate now, given the paring back of expectations on the back of that speech, we do expect they're going to over-tighten to such an extent that we are going to see a recession next year, and that's yet to feed through into the employment data. And then to the second point, I think it's really around earnings continue to be mispriced, and it's why we are still underweight developed market equities because they're too optimistic.
Right. So why the optimism? Is it because we were coming back out of 15 years of growth and actually an understanding that everything will be fine? Or are there glimmers of hope where the market could be right?
Well, I think at this point, and the way BlackRock's positioning it, is this is a new macro regime that is going to be marked by higher inflation. So that requires a new investment type of playbook, one to actually position quite differently than that great moderation that we've seen over the past several decades. So I think at this point, it does require investors to really rethink their allocations and portfolios.
So where do you find the best value right now? Or where do you invest to make money?
Well, it's really about taking a selective approach. And the way we do this is through two lenses. So one, taking a risk-on, very granular approach to portfolios. So looking where those market risk pricings are to find those opportunities to dial up risk. So we like European banks, for example. We still like traditional energy, clean energy, but as well taking a bit of a defensive tilt as well. So healthcare, yes, it's a little bit expensive at this point, but we do think it's going to benefit from those near-term tailwinds of demand, but as well those long-term structural forces around aging demographics.
Laura, thank you so much. Laura Cooper, their senior macro strategist for iShares EMEA at BlackRock. She stays with us now. Coming up, as Cyril Ramaphosa's presidency and government is engulfed in scandal, we also speak exclusively to the South African finance minister. He's Enoch Gondogwana. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the South African rand has tumbled towards its worst decline in 6 years as Cyril Ramaphosa mulls resigning over a growing scandal engulfing his presidency and his government. We're now joined by the South African Finance Minister, Enoch Gondogwana. Minister, thank you so much for joining us on Bloomberg TV this morning. What are the kind of conversations that you're having with investors and conversations within your party?
Look, with conversation we've had to investors, the latest conversation has been around the medium-term budget policy statements, where we've been looking at how we view the outlook, how is our fiscal framework, discussing all of those elements, which has been positively received.
But so, Minister, what does this mean? What's the latest thinking on your party, on your president? Does he need to go or can he stay?
Look, we have been watching the developments in Parliament. Parliament set up a committee called Section 89 Committee, whose intention is to establish whether there is a prima facie case for impeachment. The committee has released its findings on Wednesday, and Parliament will examine those findings and take the appropriate decision on Tuesday, the 6th. What we anticipate is that on Tuesday, the 6th, it will only be a process. There will not be a final discussion. That process, if agreed upon, will probably lead to, if an impeachment takes place, and then they will another process will unfold. And if a decision is recommended for impeachment, it's going to require a 2/3 majority of Parliament. But from the party perspective, the party's national executive.
No, sorry, go ahead.
The party's national executive, the party's meeting this afternoon at 2.
And what do you think will be decided at 2? So if there are grounds to go ahead with impeachment, will the party encourage the president to step down?
My own summation at the moment is that the party upholds this constitution and therefore would not be found wanting on the principles of accountability and democracy. To the extent that is an accountability process, I think the party will probably agree to that process to take its course, and the president be held accountable and explain to Parliament and whatever it does. I don't think the party will object to that. Whether the party then, when it comes to the final decision, will agree with the final decision, I don't know.
Minister, President Ramaphosa is widely considered market and investor friendly. In the case he were to step down, and given all of the uncertainty about his future, impeachment or otherwise, what message would you give to markets and investors today?
What I would say, interesting enough, with South Africans, we've got a kind of a turbulent kind of a political process where new democrats were kind of marked by a lot of these disruptions and disturbances. The smooth transition we've had is only one from Mandela to Mbeki. Since 2007, we've never had a smooth transition. And it has never had an impact on the macroeconomic framework and policies which we've continued to pursue. So it's even if you read the newspaper today, it's noisy, it's our nature.
But would you be willing and available to stay on as finance minister if President Ramaphosa steps down?
No, I mean, I serve at the request of the current president. If any new president, if he steps down, a new president asks me to stand, I will have to evaluate that depending on the policies is likely to pursue. But in general, yes, I will stay.
Minister, your budget update last month showed a marked improvement in debt and deficit trajectory. Are you worried that the scandal will reverse that progress?
No, it has got nothing to do with the macro variables at all. It's not likely to impact with pursue. The budget we're going to table in February will be based on the fiscal framework which we have tabled on the 26th of October. So I don't see that impacting on those macro variables.
But Minister, I mean, credit ratings, right, are suddenly saying that there's maybe an inflection point. If you have a change in president with possibly new policies, this would 100% have an impact on macro policies and the debt trajectory and everything that goes with it.
No, well, you know, the difference people compares us to the Americans. The Americans, a president has got a policy. In the South African context, the policy does not belong to the president, it belongs to the party. What you should watch is not who is elected, is what content emerges out of that conference in the form of policies. Any president is not going to pursue individualistic policies outside the policy framework of the party. So, to me, that's not a major worry.
But this could hurt the chances of the ANC going into elections or not?
The ANC is going to go into an election. I'm quite convinced a number of people are beginning to write an obituary for the ANC. As a leader of the ANC, I do not accept that narrative. I think we'll still be a major player in 2024.
Minister, you're pretty optimistic that actually, you know, the political uncertainty may have unnerved investors, but actually doesn't change the trajectory of South Africa. Will a lot depend on actually what the ANC decides? I know you meet at 2 p.m. When will we have news on what was decided?
Let me just say this type of sensitivity arises. I don't deny that when Mbeki left in September 2008, a similar challenge faced us. When Zuma left in 2018, a similar challenge faced us because they didn't leave the office in a procedural way. So what I'm trying to say to you, we are used to this kind of disruption, and we've always found ways of managing it.
Minister, President Ramaphosa has no obvious successor.
It does not. It does not mean, as I'm saying, it does not mean we've accepted that President Ramaphosa is leaving. I'm just saying in the case of that happening, we will find ways of managing it, but I don't see it happening at the moment.
So what's the likelihood, if you're a numbers man, an economy man, what's the percentage chance of the president leaving? Is it 50-50? Is it higher or lower?
10%.
10% if he leaves. And the successor would be whom? Because there's no obvious successor right now.
There's no obvious successor for now. My prayer at the moment is that he remains, he wins the election of the party in 10 days' time, and we proceed, whether there's an impeachment, it's a parallel process. We proceed with that. We go to 2024, win the elections. He's popular more than the party. Both our internal survey and survey by other partners is popular with South Africans more than the party.
Minister, thank you for your time today. I hope we make this a regular occurrence as we continue following, of course, some of the travails and opportunities in South Africa. Enoch Gondwana there, the South African finance minister, joining us this morning. Now, coming up later in the program, Goldman Sachs also warns its traders that bonuses will be slashed. So we look at the economy. We also go back to the South African story. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The European Union is closing in on a deal to cap the price of Russian crude oil at $60 a barrel. It's the bloc's latest attempt to clinch an agreement before a Monday deadline. But we're told Poland continues to push to harden the sanctions package before signing off on the price cap. Talks are continuing. In the US, President Biden says he won't apologize for a new climate and tax law that European leaders say unfairly subsidizes American companies. The row is threatening to overshadow the visit to the US by French President Emmanuel Macron. The EU has said it may take the US to the World Trade Organization over the law known as the Inflation Reduction Act. OPEC has slashed oil output by the most since 2020. That fulfills a new agreement aimed at stabilizing world oil markets. Group leader Saudi Arabia led the cuts, followed by its Gulf neighbors Kuwait and the United Arab Emirates. The 23-nation alliance angered the US when it announced a significant supply cut in October, with the White House accusing Saudi Arabia of endangering global growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now let's get back to Laura Cooper, senior macro strategist for iShares EMEA at BlackRock. We were talking, Laura, and thank you so much for staying with us. We're talking a little bit about some of the opportunities and where the smart money goes. I don't know whether there's a huge difference on whether European countries find a price cap or whether you look at ECB. Like, what are the main shifts that you'll be looking out for in Europe in the next 6 months?
I think the two things that we're watching for are any changes in risk sentiment that are actually looking to be sustained. That's not our kind of base case at this point. And the second thing is what's in the price. So we think at this point, given the significant rally that we have seen in European equities since those earlier November lows, that's farther away from pricing in the recession risk. We still anticipate multiple quarters of contraction coming through the European economy, which is not accurately reflected across European benchmarks. Now, when it comes to the ECB, I think there is this upside risk of them tightening even further. We did have comments from Christine Lagarde earlier today highlighting that this is an exceptionally uncertain environment. They want to keep inflation expectations anchored. So that's really the key thing we're watching for is guidance from them.
Laura, how risky is it in the next 2 months? I know we've had a relatively mild winter so far. And so I don't know whether we've forgotten how tricky energy prices are for inflation or whether you think that's already priced in.
Well, I think we have yet to see peak in core inflation in terms of Europe, and that's the key focus that we're going to be watching for. Now, as we head into the back end of the year, we do have this technical Santa rally. There's really hard to see a key catalyst to kind of curb this risk rally that we have seen, but certainly looking into Q1, I would expect that those inflationary pressures are going to feed through more materially to margins, and at that point, the economic deterioration will be most acute, and I would expect that that's when risk assets are going to have even more pressure.
Laura, do you get into UK assets? I feel like we beat up on the UK economy every day. There must be an entry point.
I think certainly there has been attractive entry points. Looking at the FTSE 100, for example, it has been a strong outperformer so far this year. But it really kind of the investment base case for us is looking for very selective opportunities. So whether that comes in terms of energy, whether that comes in terms of very key kind of healthcare sectors within that. But more broadly, I think there's still a lot of challenges facing the UK economy that takes us away from staying kind of high exposure within UK assets.
Laura, thank you so much. Laura Cooper there, a senior macro strategist at iShares EMEA for BlackRock. Coming up, the chair of Credit Suisse also tells us that outflows have stopped from the embattled lender. More from our exclusive interview with Axel Lehmann. That's coming up next, and this is Bloomberg. Well, here are your top stories. Waiting on jobs, Asian equities and U.S. futures edge lower after a key inflation gauge comes in softer than forecast. The next clue on the health of the U.S. economy, non-farm payrolls. Crisis in Cape Town. South African President Cyril Ramaphosa weighs resignation amid corruption allegations. The rand takes its worst tumble in 6 years. Plus, bank cuts. Lenders start slashing bonuses and jobs. The chair of Credit Suisse tells us that outflows have stopped from the embattled lender. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the chairman of Credit Suisse says the bank has mostly stemmed the huge outflow of clients' assets that have helped send their shares to a record low. Well, Axel Lehmann spoke to me earlier.
Of course, that's never easy. We have quite a lot of roughly some 10 key investors. They are long-time investors. They are not pleased where the share price is, of course. But, you know, they welcome our plan to transform the company. They have a high belief in the credibility of the management team. So they are standing by. But, you know, they are somewhat impatient. They want to see the change. They want to see us executing. And exactly that's what we are doing.
So what kind of conversations are you having with them? Are you confident, first of all, that the share price after the rights offer will go up?
Look, we are at 0.2 or so price to book. All our peer companies in our sector are roughly hovering around book, slightly below, slightly above. There's no reason that we cannot, catch up and go back to that level. Obviously, I cannot predict when that is happening, but the upside potential is huge.
How much? So what I'm trying to understand, what a lot of people are trying to understand, is that every day there's bad news on Credit Suisse, and you see staff leaving, you see investors unpleased. Like, how do you recapture that narrative?
Look, we had, beginning of the month, we had that social media storm that had a huge impact on, interestingly, not on the institutional side. Professional investors understood there was a lot of rumor spelling, but on the retail and wealth management side. So we reached out. We reached out to 8,000 wealth management clients. They are covering roughly 80% of the assets under management. We reached out to more than 24,000 clients on our core market. So we intensified the dialogue. Just to make sure they understand where we are and just to make sure we maintain the contact. But
what was the feedback like? So if I'm a new client, if I'm an old client, why would I put 100 million with all of the uncertainty surrounding Credit Suisse?
No, the feedback is quite astonishing. The clients still like us. They continue to do business with us. So we had basically very few clients really leaving. They might have, in light of those rumors, withdraw, some money from us. But I'm confident. I have a lot of personal discussions with clients. I know from regional management, that money, when we do well, will come back, at least to a significant part.
When do you think the outflows will stop?
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
I mean, a number of analysts are also talking about, what could happen to Credit Suisse. So are you evaluating other strategic options, given the share price dilution and the market reaction to your announcement?
Look, when you step back, we do a capital increase now. In 4 working days, we will have 4 billion with a CET1 ratio of 14% or close to 14%. That is top quartile in the industry. So it's a really strong balance sheet to carry through that transformation we go. So we execute our plan.
But why do shareholders not believe you? Why does the share price keep on falling?
No, I think the shareholders, core shareholders, they believe us. And they will exercise also their rights. The share price is falling, yeah, of course. You know, the rights issues are traded. The market tries to drive down the price, which is logic, but it's fully underwritten, will be done. So the volatility on the share price will continue until we are through that, capital increase. Then I think it will somewhat, stabilize and probably, we just move on from there.
So, Chairman, no plan B. Is there a plan B? If somebody came today and said, look, I offer you to merge 10 Swiss francs. Or share?
Look, as chairman, you need always to consider all. When somebody comes and would do that, of course, you need to take a look. But, I tell you, when you are where we are, with the historically low on the share price, with a great management team, with a plan that is convincing the market, and the market, our shareholders believe it. It takes time to execute. Yeah. We can capture that value, and we will do so.
How difficult is it to retain staff?
It is obviously a challenge. We have so many people, 50,000. I think they are very much under pressure, very committed. We have still excellent people, and the good thing, we continue to attract and hire, I think, very, very strong caliber individuals. Yeah. But it's something to watch closely, clearly.
But how do you attract them? So again, because the franchise is tainted, do you have to have difficult conversations with people?
It's interesting. Also, when I look to people we attracted at the board or in the executive committee, they see it's a great franchise, a franchise that is a little bit hammered, but they see the opportunity, they see the potential, and they think that is what attracting new talent.
But the worry, I guess, is that if you have Credit Suisse on your CV, does it make you then less applicable afterwards? Are these conversations that you have with people, or it's not a problem?
No. Look, we should not forget, Credit Suisse is one of the best brands you can have. It's not only Switzerland, but you go to Asia, you go to Latin America. I mean, it's a super brand and such a rich history. And in every time in life, we have ups and downs. Yes, we are not in the best shape, but we are getting back, and that is what people see, and that's what they believe.
So when are you expecting inflows to increase? We talked a little bit about the outflows and when you're expecting them to stop. How do you attract new clients?
No, I said I already see now. Anecdotally, when I speak to clients, I know, that there will be inflows. We already see it partially happening. So we have plans to continue to reach out to clients. It might take a little bit of time, but it will come back and we'll go back to normal. I think we just go now through a little bit that storm during the capital increase. When we are done, and then you start to work step by step. No rush, step by step, executing a plan, and then we are going back on track.
That was Axel Lehmann, the chairman of Credit Suisse, speaking to me a bit earlier. Now, coming up, as the Ramaphosa presidency and government is engulfed in scandal, we talk South Africa politics and economy and also investments with 91 Chief Executive Hendrik du Toit. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, South Africa's rand is extending gains after 2 days of turmoil, but traders are bracing for more short-term upheaval from the leadership crisis engulfing the ruling ANC party and President Cyril Ramaphosa. Well, let's get straight to Hendrik du Toit. He built the asset management arm of South African banking group Investec from scratch in 1991. He pressed ahead with its listing, renamed 91, on both the London and Joburg stock exchanges during the coronavirus outbreak. And Hendrik joins us now. So thank you so much for joining us. So you understand South African investment and politics more than most. Where are we now in terms of the processes put in place and what this scandal and these alleged, theft means for President Ramaphosa?
Good morning, Francine. I think what's important for outsiders to understand is that South Africa has a very strong constitutional framework. Yeah. For all its flaws, it is a parliamentary democracy, noisy as it is, that works. And what is followed here is a report from a panel that advises, at request of Parliament, is advising Parliament on what they should do under their Section 89 of the Constitution, or the obligations they have under that when there is a question about the behavior of a president. Then there's a ruling party. And I saw you spoke to the finance minister, who's also a senior member of the ruling party. The ruling party has its own processes and is a few days away from a leadership election. So that is the complexity.
Yes, and in that interview with the finance minister, also part of the ruling party ANC, I mean, he was very clear, first of all, in reminding everyone and reminding investors that South Africa is not like the United States of America. I think he said something to the effect of, we're used to alleged scandals and it's fine for the economy. I mean, is there truth in that? Again, because it's complicated and we don't really know if impeachment comes, if there's ground for impeachment, or the president fights, what does it mean for an investor?
I wouldn't quite agree with your summary. I think what Inogwanagwana meant was that South Africa has a parliamentary democracy, and the president is also constrained by the ruling party, and the party has very strong structures, which means the president must abide by both, and therefore whoever is president has to follow the party and play by the constitutional rules. And remember, we got rid of the previous president in a process similar to that. So the country is used to doing that. I think where we are really, where the markets are worried and where people are concerned, is Ramaphosa was a reasonably market-friendly president, has spelled out some clear policies, all of which have not been executed, but at least are understood by markets.
But so, Hendrik, talk to us about if the ANC holds the ultimate power, right? Maybe even more than the individual, then the policies wouldn't really change under any president, although there's not an obvious successor.
The whole National Executive Committee will be reconstituted on the 16th of December at a conference, ANC conference. The president of the ANC, and Ramaphosa, was standing for re-election and is standing for re-election, will obviously lead it. So it is very significant for the country as it then goes into a general election here in 2024. So that's really, and so does the country need this? No. Does the country have the wherewithal to process this? Yes. But the next big date is the 6th of December, when Parliament is debating this. And so I think having a, it's not a one-day game would be my answer. And therefore, if you're in markets, you should be thinking about a few months of uncertainty in South Africa.
What happens in those couple of months of uncertainty? I know there's pressure on the rand. There's, what's almost a shame is that there was just a turning point for credit ratings when you look at that debt trajectory. 100%,
and actually quite a solid, as the minister spoke to you about this morning, solid fiscal framework, fairly good results, a central bank that is in control of the inflationary situation. So you had all these sort of reasonably good things, and then you get this. Now, the president ought to answer some questions in Parliament, and I think that is the right venue for him to answer questions. We will see. There were rumours yesterday that he may resign. I think the hints are to the contrary, that he is actually going to go into the process saying, look, a report has been written. I dispute some of the issues. And by the way, the report is not damning. It used the word prima facie or phrase, and that may even be disputed. But there are questions to be answered, and we're in the middle of this very volatile political moment.
Hendrik, are you cutting exposure to South African assets?
I think the time to have cut exposure was to cover for the uncertainty of an unexpected report by Judge Ngobo. That happened. I think right now we see things fairly valued, and we're looking ahead. We don't think the policy trajectory of the ANC will change significantly, but there is a risk that a particular faction that is associated with the corruption under the Zuma administration may gain too much power. I think that is the moment to watch out. So post 16 December, we will have much more knowledge, and markets will probably be cautious until then.
Hendrik, I mean, this is not a sleepy Friday. We also have the U.S. jobs reports. And we've talked about this in the past, the fact that markets want to believe only the part where the Fed says they're not going to hike as aggressively without really understanding how much they need to hike to fight inflation. What are you expecting from jobs today?
I think on the jobs report, I don't think it's the main short-term number.
Yeah.
To me, and the U.S. economy has been pretty dynamic, so you could have a good news, you could not have, who knows. I think the point here is you need to argue, will central banks be more conservative than markets estimate or not? Our view is very clear. We think Jerome Powell does not want to be Arthur Burns, and we think that central banks, having been behind the curve, most likely to err on the conservative side, and therefore we're still in for a period of volatility, and these sort of wonderful days like last week, just before the weekend, are days probably not to be believed.
But Hendrik, is volatility a polite way of saying correction? If interest rates go up to a level where they need to go to fight inflation, what does it mean for equities globally?
We think the tussle between the bulls and the bears is not over. And therefore, this is a market which you have to trade rather than see direction. Once we are clear that interest rates have peaked, there is room for bullishness in risk assets. We are still some way away from there, and that's really the key point. And therefore, if you have these big moves, beware on which side of them you are, and we definitely at 91 are in the middle rather than just immediately believing the good news, because I think it's too early for all the good news. And last week we saw the markets unwind.
So traders are finally earning their money for real.
Traders,
volatility.
And traders have a real place in this market.
When does it stabilize? Mid next year, or does it take longer?
I think our view is towards the second half of next year, we'll have much more clarity. Clearly, if you're a long-term investor, you want to position ahead of that. And so data over the next few months will be followed very keenly, and then one has to build scenarios. But we are in for a week here economically, globally next year. And if we look at the news out of China, it is yes, the markets have bounced, but there's still a lot of work to do to get global demand up to where we can have a good economy with a stable interest rate environment.
Yeah, we need another 2 hours to talk about China, so we'll get you back in. Hendrik du Toit, thank you so much for joining us today. That was the chief executive of 91. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Blackstone's $69 billion real estate fund for wealthy individuals says it will limit redemptions. It's one of the most dramatic signs of a pullback at the top profit driver for the firm and a chilling indicator for the property sector overall. The news sent Blackstone shares falling as much as 10%, the biggest drop since March. Now, Wells Fargo has cut hundreds more mortgage employees, the latest in a series of reductions across the industry. That's as higher rates brought the pandemic-era home lending boom to a halt. We're told the reductions are taking place across the U.S. The firm isn't alone. Rival J.P. Morgan cut hundreds of home lending staff back in June. Now, Goldman Sachs traders are in for a nasty surprise this holiday season, a cut to their year-end bonuses. We've been told executives in the firm's global market division were told this week that its compensation pool will be slashed by a low double-digit percentage. That's despite the division being on its way to posting their biggest revenue haul in almost more than a decade. And Jefferies is also warning staffers that the upcoming bonus season will be difficult. That follows a volatile year across Wall Street. Bonus pools are set to drop sharply across the finance industry amid a pullback in M&A activity. Jefferies says the process for compensation will be done fairly and also transparently. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, a rude awakening. Goldman Sachs warns its traders that bonuses will be slashed. So we'll have plenty more of that story that Leanne was also talking about. We're at the compensation discussion stages. So what happens next? This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Goldman Sachs traders are in for a bit of a rude awakening. Bloomberg has learned that the lender warned executives in the global market division that its compensation pool will be slashed. The bonus reduction by a low double-digit percentage follows a similar warning from Jefferies, which blamed a volatile year across Wall Street. Now, for more, let's get straight to our finance team leader, Tom Metcalf. So, Tom, first of all, good morning. How big of a surprise is this Goldman news?
Yeah, big surprise, I think, particularly because of the area it's in, right? Everyone's expecting the investment bankers to have a bad bonus season, but the traders, those are the folk who've been really supporting these results at the Wall Street banks. So the fact Goldman is coming out and saying, hey, traders, guess what? Your bonus pool is getting cut. It goes to show just how closely they're watching costs. And also, I think, you know, this year's been a great one for traders, but maybe they're looking ahead the next couple of years and worrying, can we really sustain those kind of results?
So is this something that will happen across the industry? And actually, how surprised were you that that we find about this unit?
Yeah, I mean, look, if Goldman are doing it, I think you can expect others to be following suit. They're normally sort of the bellwether for the industry. And, it's not like their traders have done badly. So the fact, even in a good year for their traders, that they're looking at these kind of costs, that is very surprising. And I would therefore expect other firms to follow suit. You had Jefferies this week also kind of messaging to its staff, hey, this is going to be a rough bonus season. And certainly what is clear is that if you're an investment banker dealing with M&A, or ECM, you're going to have a very big drop from last year.
Tom, I know you and I often speak about Credit Suisse, when we catch up and just have a cup of coffee in the pantry. What did you make of the Credit Suisse chairman? I thought he was quite candid and actually, encouraging without sugarcoating anything that they have to do.
Yeah, no, great get on your behalf, right, to get him speaking today. And I thought what he was saying was, as you can see in the share price, just really what the investors are looking out to hear from. Basically, they've managed to stem those outflows, which is the first thing, the most essential thing they need to do. And it'd be very curious to see how the bank goes forward, into Q4. Will there be any more messaging outside of the earnings cycle, or will it, get to January, February, and from Credit Suisse's perspective, they'll hopefully be able to stand up and say, not only have we stemmed those outflows, we've actually started to see money coming back in.
So Tom, you give it. So this is basically in the next 3 to 4 months. Well, we'll see if the proof is in the pudding.
Yeah, I mean, next quarter particularly be critical. It's just been quarter after quarter of bad news. So I really think at this point, Buck's got to stop here. They've got to show signs they've managed to wrestle the bank to the ground almost, and this big sweeping restructuring is at least starting to kind of take shape. And there's starting to be some kind of benefit seen from it, because if the doom and gloom continues, it's very bad news for Credit Suisse. Tom,
thanks so much. Tom Metcalf with a very cool looking Damien Hirst-like art in the background. Our finance reporter, Tom Metcalf. This is Bloomberg.
I think right now the Kool-Aid is the gloom and doom.
That post-pandemic distortion is probably going to last for some time.
There is an extremely elevated chance of recession. And if you had to place your money, I bet that within 12 months, the economy is in downturn.
The most predominant factor that's driving everything right now is where global equities are going.
We have more confidence that this rally will continue into December.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Waiting for today's U.S. unemployment report, job growth is expected to slow down, but the question is whether the Fed will consider it a turning point. A tale of two banks. Credit Suisse says it is mostly stemmed the outflows that sent the stock plunging to a record low. Meanwhile, Goldman Sachs jolts traders with a warning that bonuses will be cut. And the US ramps up its investigation into FTX. It's pressing top users for information on the failed crypto exchange and its key figures. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London alongside Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. And Kailey, you look across the Asian markets, giving up some of the gains after what was a very strong week for Asia.
Yeah, it definitely was a strong week, but you saw risk sentiment maybe being toned down ahead of the jobs report today. Happy Jobs Friday, everyone. It definitely was a down day for equities, but bonds were bid in Asia overnight. The MSCI Asia Pacific Index as a whole, that equity gauge down about 0.5% after a 3-day winning streak. It snapped that rally. And then the bond market, as we saw Treasury yields moving lower yesterday, follow through of that in the Asia Pacific overnight, including in Australia and New Zealand. In Australia, the 10-year yield down 9 basis points to the 339 level. Then in foreign exchange, when we talk about a good week, we have to talk about the Chinese yuan. The onshore yuan having its best week against the U.S. dollar, going all the way back to 2005. We're talking 17 years right now. Dollar yuan trading at 702.27. And then it also was a good week for iron ore. Actually, the 4th consecutive up week for those commodity futures. That's the longest winning streak going back to December of 2021. Iron ore right now trading around $105, Matt, and that is the highest level since mid-August. It all comes back to the optimism about that China reopening story.
All right, very interesting look at what's going on there. In terms of here, not a lot. S&P futures pretty much unchanged. And I think traders are waiting for this data to come out before they make any moves. We're looking for about 188,000 jobs to 200,000 jobs. I can't remember which one is the whisper number. You can type WHISGO on your terminal to see what other Bloomberg clients are betting on. The Bloomberg U.S. dollar index coming down. Treasuries coming down. The yield going up. 352.26 right now. So this is actually a low yield and a low dollar, kind of a tailwind for stocks. Now we have to wait to see what the non-farms payroll number is. Used to be like the granddaddy of economic statistics, the most important release. I would say the CPI now, maybe just for the shock factor, is a little more closely watched. Bitcoin, by the way, still at 17,000. Well, still, it was yesterday eclipsing 17,000. It's amazing to see that after we crashed down to 16 in the wake of the XTX implosion, we've steadily climbed back up. So even though it was a bad month, November was a bad month for Sam Bankman-Fried and a bad month for Bitcoin, a horrible month for a lot of FTX clients, the underlying asset has retained real stability and actually began to climb. Tom, very interesting stuff. What do you see in Europe?
Yeah, that stability around Bitcoin is a real head-scratcher, isn't it? Kathy Wood still sticking to her $1 million a coin call for 2030. Novogratz reducing his call, though, on crypto, at least on Bitcoin. Yeah, across Europe, look, the sentiment, of course, more broadly, since October has been upside. Year to date, you're down about 9% on the benchmark here in Europe. But since October, you have seen gains of around 14%. Today, though, losses generally across the board. Apart from Germany, the DAX is just up 0.2%. Here in the UK, you're down 0.3. There is that holding pattern, as you've been discussing, ahead of the non-farm payrolls. There's the benchmark then, down 0.1%. We are, of course, also focused on what happens around the jobs market in the US and what it says about the Fed's direction of travel. The pound, though, getting a leg up just by 0.1%, and it's been a good week for sterling as well. 122 on the pound. A couple of individual corporates, just to bring to your attention, there's been an upgrade by Goldman Sachs for AB Foods. It's the owner of a retail company called Primark, cheap clothes, currently up 3% on the back of that upgrade by Goldman Sachs. Credit Suisse, of course, that exclusive interview between the chairman and Francine Lacqua. We'll be playing that out across the hour. And the chairman saying outflows has essentially stopped. He's even starting to see some inflows as well. There's going to be volatility, he said, during that capital raise, but then he expects stability around the price. Again, there, 6% for Credit Suisse. Matt.
All right, we're paying very close attention to the banks today. Investors are awaiting the U.S. jobs report as well to see if it provides any clues on the Fed's next move. Mike McKee, Bloomberg International Economics and Policy Correspondent, joins us now. So, Mike, what do we expect from the number?
Well, it's interesting. This number hasn't moved around a whole lot in terms of expectations, even though we had that weak ADP report earlier and then weak employment numbers in the ISM. 200,000 has been the forecast from the Wall Street economists that we survey for about 2 weeks now, and nothing's really moved them off of that. 3.7% is the unemployment rate that's forecast. That did move. There was a thought that it might go up a little bit, and it's not going to, at least according to the latest consensus. Average hourly earnings are expected to decelerate a little bit, and the participation rate move up just a little bit. You can see there, that's the unemployment rate, and that's going to be an interesting question. So what happens to unemployment? Because it hasn't really been going up, but as you can see there, at this point, the the unemployment rate doesn't generally start to move higher until the Fed has stopped raising rates and even started cutting them. So while unemployment may be fairly stable today, over the longer run, it is probably going to rise, and we have that ahead of us.
Well, and the question is, how much does it rise and how much will the Federal Reserve tolerate? As we look at these numbers today, Mike, is there any part of them that could flip the narrative on 50 basis points this month, or is that now set in stone?
I think it's pretty much set in stone. The question is going to be almost immediately, what are they going to do at the late January, early February meeting, because we're always looking ahead. And that may depend, at least according to what Jay Powell said the other day, on average hourly earnings. His view is that inflation now has sort of moved into the service sector category, can't find enough workers, they're paying more to bring workers on, and that's contributing to inflation. So we take a look at the average hourly earnings outlook, and we have a base effect that drove it up earlier, a base effect that's pulling it down now, but the Fed wants to see average hourly earnings in the 3 to 3.5% range to be compatible with a 2% inflation rate. So keep an eye on that and movement towards that direction.
Yeah, those wages still well above pre-pandemic levels, of course. Mike McKee, thank you very much indeed, previewing, looking ahead to that non-farm payroll number. Stay with Bloomberg for full coverage of the US jobs report, plus an interview with Labour Secretary Marty Walsh. That is at 9:45 a.m. New York time. That's 2:45 p.m. here in London. Now, in banking news, the chairman of Credit Suisse says the bank has mostly stemmed the huge outflow of clients' assets that have helped send the shares to a record low.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Okay, we are joined by Bloomberg's finance reporter Tom Metcalf. Tom, what is the latest with Credit Suisse? How important were these comments from the chairman around outflows and indeed the sentiment amongst clients?
Absolutely vital, and I enjoyed his description of the October outflows as woof, very appropriate. But no, the fact that he's saying, hey, these outflows have been stemmed, and actually in Switzerland we're seeing some inflows, is certainly going to be cheered by investors. And you can see that in the share price. You know, it's up a couple of percentage points today, is after long weeks of sort of down performance. So this is what shareholders needed to hear, and obviously now the question is, can they continue to do this? Can they really start to show they're sort of wrestling these problems to the ground and have a viable reach out of this mess?
So that's what shareholders want to hear. In terms of bank employees, I'm sure at Credit Suisse, but also at Goldman Sachs and at Jefferies, they're starting to worry about bonuses. How hard a compensation season is this going to be for bankers?
Yeah, it's looking pretty unpleasant. I think it's been widely flagged before, investment bankers are going to have a really torrid time, at least compared to last year. You know, you're seeing M&A activity way down, ECM activity basically non-existent. So those folks will see very, very big drops in their bonuses. But what was really interesting last night, it had a scoop out of Bloomberg News' crew in New York about how Goldman traders, and these folks have done very well this year, they're also going to see their bonus pool cut. I think the figure was something in the low double digits. So that goes to show, you know, it's not really about performance this year. It's really a cost story. And also, you know, bankers looking ahead, the executives looking ahead at coming years and thinking, we might have a rough ride here, so we better start cutting costs now.
All right, Bloomberg's Tom Metcalf, thank you so much. And we're going to have more from that Credit Suisse chairman interview later on this hour. First, though, we also have to talk about crypto, because delusional. That is how Galaxy Digital CEO Mike Novogratz described the interview with Sam Bankman-Fried at the New York Times Dealbook Conference earlier this week. He joined Bloomberg Television yesterday, and he basically said, collapse of FTX aside, he's still bullish on crypto in the wake of it. He spoke. Take a listen.
This is a setback for crypto, but there's an inevitability that digital assets are going to be part of our future, and we're going to make that bet. We are going to lean into the opportunity set that we see. There are a lot of cheap assets right now. There'll be a lot of distressed assets. We're going to build for where we think the puck will be in 2 years.
Joining us now for more is Bloomberg crypto reporter Anna Herrera. So, Anna, does Mike Novogratz have good reason to still be bullish?
Well, he runs a crypto firm, so we'd hope that he wouldn't say I'm negative. That would be great for his company, his investors. So, I mean, to be fair, like Bitcoin hasn't fallen that much as you would have expected, given sort of the catastrophe that happened at FTX. So there might be an argument there. We're still seeing some banks working on issuing securities on blockchain. So, if you're thinking of a future where digital assets isn't only necessarily the cryptos we see now, there might be something there. But obviously, as I said, you have someone who runs a crypto firm say, we believe in crypto. So,
We have obviously reporting that shows authorities are asking investors and trading firms that had relationships with FTX what was happening there. You can find that on NINSS on the terminal. Why haven't they gone to get Sam Bankman-Fried? Everyone is asking, how come he's still in the Bahamas? How come the DOJ hasn't picked him up?
Maybe he has a very busy speaking engagement, so they can't squeeze time in. I don't know. I don't have the answer to that. I guess this shows they are working on cases. We have reported that they are. It's interesting because, again, we've been hearing Sam Bankman-Fried speak a lot. We had a big story as well today in Business Week. But it's still unclear exactly what happened. I think what he's admitted to is that there was a large margin position that Alameda, his trading firm, had on the exchange. What's still unclear was whether they used customer funds or not to cover that big hole.
All right, Bloomberg's Anna Herrera, thank you so much. Now, another story we're watching this morning, Apple's iPhone 14 production may fall 16 million units shy of expectations this year, according to UBS. Analysts slashed their forecast to 76 million units for the second half of 2022, down from 92 million, which would be a 20% drop from 2021. They attributed the lower expectations to both the manufacturing disruption faced by Foxconn and softening demand for lower-end iPhone 14 models. Interestingly, though, despite that bearish analyst outlook, Apple shares are very little changed in pre-market trading this morning. Actually, essentially not changed at all, trading around $148 a share. It is a much larger change to the downside this morning for Zscaler. This is a cloud security company reported after the bell yesterday. Its calculated billings coming up short of the midpoint of analyst expectations. Analysts really just blaming that on macro headwinds. That stock is down about 9%. And Marvell also down. This is a chip maker for data center chips. Its forecast disappointing. And what that really signals, Matt, is that the slowdown in chips is spreading beyond just PCs and smartphones. It's hitting data center as well. And as a result, Marvell is down about 7% before the bell.
Yeah, that's interesting. Now the hardware being drawn into the software concerns, because we'd already gotten warnings from companies like CrowdStrike and Snowflake. So we'll be watching this space very closely. Coming up on this Jobs Friday, Hugh Gimber, global market strategist at JP Morgan Asset Management, and Sandra Horsfield, economist at Investec, talks to us about what to expect from this big number we're awaiting at 8:30. This is Bloomberg. Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards normally with us out of London, but we have T-Mac today filling in because Anna is out. We're all waiting for this non-farms payrolls report, and it's going to be interesting because, as Michael McKee was telling us, Wall Street has consistently underestimated the amount of jobs that we get, at least for the last 7 months in a row. That's a record, 7 months in a row of NFP data that was higher than the street was looking for. Joining us now is Lynn Thomason, Bloomberg Markets editor. Lynn, what are we expecting for today?
Yeah, absolutely. Well, I think clearly everyone's watching what will come out of this jobs report. Clearly, the interest in markets is this going to be the turn of inflation? Will we see a softer jobs report? And will that give the Fed the confidence that it can start going slower on rates?
And Lynn, it's been a great month in terms of how you tie that into what's happening across the equity markets. It's been a great month for global equities, whether you look at Europe or the US or indeed Asia. Is this the fringes of a Santa rally, or are things going to fade? Is that NFP number going to give more juice to this market?
Yeah, absolutely. And I think, the interesting thing is everyone's talking about the Santa rally, but in some sense, we've already had a Santa. I mean, there's been such a big rally already. So I think there's a good question of, are we reaching the peak of that, or, will the jobs number give us the fuel to keep that going?
Well, Lynn, it's also a question of when it ultimately will end, even if it keeps going in the near term, because the consensus building seems to be that, okay, we can see the Santa Claus rally. The rally can go on through the month of December, but first quarter of 2023 going to be a very different story. And actually the consensus outlook developing around next year just in general is that stocks are going to end the year a little lower than they are right now, which is the first time it's happened in what, Miller? Matt Miller?
Like 23 years.
23
Since 1999, we haven't had the average strategist on the street estimate lower for next year than it is this year.
Yeah, Lynn, what do you make of that?
Unbelievable. I think, you know, it really speaks to the level of worry in this market. I mean, strategists are typically such a bullish group. I agree. I can't remember a time where strategists were predicting a down year. So, you know, it speaks to the fact that even though we've seen a bump up in stocks, there's clearly a lot of nervousness and worry about what the next year will bring.
Lynn, the other big story this week, of course, was what was happening in China. And there's the growing expectation you're going to get some kind of reopening next year. I'm still struggling to understand whether this is deflationary because supply chains ease up or inflationary because suddenly China is back and sucking in commodities again. How are markets thinking about China in 2023?
Yeah, I mean, that's a perfect example of the story. Are they opening up or are they clamping down? And you can kind of see that confusion in how Chinese officials have reacted this week. You know, in some sense it's going to be harder, and then the next stage, well, we're actually opening up sooner than everyone thinks. Your guess is as good as mine on how it'll play out. But I think, you know, if you look at Chinese equities overall, they're down a lot this year. People have taken some severe losses, and people are probably wondering, when can I get in and ride the growth story when it does open up?
How to time that growth story around China. Lynn Thomason, thank you very much indeed, walking through some of the key market themes. Kailey.
Yeah, Tom, as we discussed China, a headline actually just crossing out of Beijing that buses and subways can't reject people with no COVID results. So again, at the margin, we're just seeing the incremental relaxation of some of those restrictions. And of course, the market and our market team at MLive, the MLive blog, continue to follow the China story and all the other noteworthy market stories to watch. For more of that analysis, you can check out MLIV Go on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Tom McKenzie in London. Now keeping you up to date with news from around the world, here's the first word. In South Africa, leaders of the country's ruling party are meeting today while the fate of President Cyril Ramaphosa is up in the air. He's said to have considered resigning after an advisory panel found that he may have violated the Constitution. The panel investigated his alleged failure to properly report a robbery at his game farm. President Biden will sign legislation that will avert a potentially crippling rail strike. The Senate overwhelmingly approved the measure, which would impose a labor agreement hammered out by rail companies, union leaders, and the Biden administration. But workers in 4 of 12 unions rejected that deal. Meanwhile, Musk's Tesla has handed over its first electric semi-trucks. The event came more than 5 years after it unveiled the vehicle. PepsiCo received the first truck. The move to electrify trucking could be transformative for an industry known for high emissions and hefty fuel costs. And Twitter has suspended rapper Kanye West, who now goes by Ye, after he posted an offensive image. He tweeted an image combining the Star of David with a swastika. Later, Twitter owner Elon Musk tweeted that Ye had violated, again, the rule against incitement to violence. Whoa. And this is what the tension is, Matt, is that Elon Musk says the reason why he took over Twitter, why he wanted to buy it, is he wants to protect free speech. But there's free speech and then there's hate speech. And for a platform that is reliant on advertising dollars, this is why advertisers may now be hesitant about advertising on Twitter, because you don't necessarily know what kind of content your ad will run next to.
I mean, you don't want your ad to pop up right next to a swastika, right? Posted by a guy who in an interview just previously had said he loves Hitler and the Nazis. It's just unbelievable and also depressing and offensive. So maybe it's better that he's just not allowed to speak publicly. Tom?
Yeah, I don't think it's controversial to say that he shouldn't be given a platform. And on the advertising, we spoke to Sir Morten Sorrell, the advertising guru here in the UK. He said, look, advertisers are not going to want to go close to this until they get clarity on these issues. Coming up, we're going to be talking markets with Hugh Gimber of JP Morgan Asset Management. This is Bloomberg. This is Bloomberg Surveillance Early Edition, and here's what you need to know. Waiting for today's US unemployment report, job growth is expected to slow down, but the question is whether the Fed will consider it a turning point. A tale of two banks, Credit Suisse says it's mostly stemmed the outflows that sent the stock plunging to a record low. Meanwhile, Goldman Sachs jolts traders with a warning that bonuses will be cut. And the US ramps up its investigation into FTX. It is pressing top users for information on the failed crypto exchange and its key figures. I'm Tom McKenzie in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. And Matt, of course, the focus is centrally on the NFP.
Yeah, we're watching the jobs number today to get some direction in this market, right? Yesterday we closed almost completely unchanged in the cash trade. Today, we're looking at futures that are also almost completely unchanged. Although it should be noted that after the massive rally we saw on Wednesday, we're back up above 4,000 on the S&P. The dollar index coming off a little bit, not by much, but we're at a relatively low level, 1254 on the Bloomberg dollar index, and we hit a high of 1353 a little over a month ago. We hit a high of 424, I think, on treasuries at that time. Right now, we're back down to 351. So 352 if you round up. Those things should be a tailwind for the equity market. And then I guess if we get the idea is if we get a lower jobs number, then the Fed can continue to really do its step down because it won't have to worry about a wage price spiral. So I guess today, bad news is good news for equities. Bitcoin right now trading at $16,960. So almost back to that $17,000 mark. We did see it eclipse $17,000 for a little bit yesterday and overnight yesterday. So the stability this month, I think, has amazed everybody in the underlying asset after the centralized exchange. FTX was just the latest and the biggest now blow up that we've seen in crypto. Kailey, what do you see in pre-market movers?
Well, we have a lot of earnings-related movers, and a lot of them moving to the downside on forecasts that missed expectations, including Asana, the software company. Its forecast came in light, and analysts are saying that this is a company that is even more vulnerable to the slowdown in the technology industry and the layoffs that we are seeing because it is so heavily dependent on the tech sector as customers. So that stock is down about 19%. You also have Marvell Technology, a maker of data center chips, down on a week forecast by about 7%, while Zscaler, which is a cloud security company, also missed on the guidance. It's down about 8%. The one more positive guidance story is a different software company, UiPath. It not only topped expectations in the third quarter, but the fourth quarter view came in above what analysts had expected. So that stock is higher by about 10% before the bell, Tom.
OK, checking on what's happening across the European equity space then. Pairing some of the heavier losses, currently down 0.1%. Yes, still a bit of a holding pattern for European investors. The context is you've seen about 14% upside for European stocks since October. Year to date, you're still off by about 9%, but it has been a decent rally in the last few weeks. The pound is in focus for us. Take your time back to that mini budget, the chaos of the mini budget of the former Prime Minister Liz Truss. Well, we're a long way from that when it comes to strength for the pound. 122, gaining 0.2%. Just how sustainable is this, though, as you look at the fragility of this economy? And a couple of corporate stories to flag. AB Foods, this is an upgrade for this company. Goldman Sachs seeing a 20% premium for the stock, currently up 3%, down year to date, but we'll see, of course, if those gains follow through. Credit Suisse, really important story here. Francine Lacqua, of course, of Bloomberg, sat down for that exclusive chat with the chairman. They say they see outflows. They've essentially stopped. Inflows are starting. Of course, they're going through this capital raise. Currently, on the back of that, up almost 6%. Matt.
Yeah, you've got to halt those outflows if you want to continue to be a leader in that business, a troubled bank that we're going to focus on a little bit later in the program. And really, banks are a huge story today, right? Because Goldman Sachs is likely to cut. We've reported bonuses even for traders who've made more money this year than last year. And Jefferies also sent out a note to employees saying it's going to be a tough bonus season. We'll continue to focus on that. Right now, I want to get back to the markets ahead of this big jobs number. Hugh Gimber joins us, global market strategist at JP Morgan Asset Management. And Hugh, I'm sure you heard my assessment that today bad news is good news for equities. Do you think that's true? And what kind of number do you think we're going to get?
I think that is true. What we're looking at in the US labour market now is a point where the only real way to bring this back into balance is to reduce demand. I thought Powell's speech actually on Wednesday gave a very good template for how to read the data today. And I thought he was very clear in saying, look, we have very limited expectation now that participation is going to improve next year. I think there's only so much that the Fed can hope for in terms of an improvement in supply. And therefore, if you want to see wage growth slowing and you want to see that number coming down to a level which is more consistent with the Fed's inflation target, what the market and the Fed want to see today is a softer print and one that points to continued moderation in 2023.
Hugh, nonetheless, I saw a story that really moved me this morning. The average strategist on Wall Street that we tally expects stocks to be lower next year, expects a drop in the S&P 500 for the first time since 1999. Typically, these strategists' forecasts are bullish, and now for the first time in basically 23 years, they're bearish. What do you think about the markets?
Yeah, I mean, first of all, if you look at the macro picture, I think there the consensus is absolutely clear, which is that we know we're headed into recession. Based on our view, that recession is likely to be relatively mild. And I think when you tally that with the moves that we've seen with earnings downgrades coming through over the past few months, we actually think lots of that kind of mild downturn now is already being reflected in prices. So I think you can see positive returns from the US stock market over the course of the next 12 months. It's still going to be bumpy. I think importantly, we still need to get more clarity on where the Fed is going to stop. But we know the economy is weakening. This is old news now, right? And so as we move through 2023, I think you could well see markets looking forward into the recovery that's to come in 2024. And therefore, we think that the outlook is relatively positive for stocks from here.
And it comes back to that question about good news being bad news being good news, I should say, as Matt was flagging. So where does that moderate optimism around equities into 2023 take you? How defensive do you still want to be in that recessionary environment, even if you think that recession is going to be relatively benign?
Yeah, so it's all about where you look within equities, right? So I think there are a couple of ways to do this with a slightly more defensive bias today. I still think that a value tilt is the right way to go, really because of the earnings picture. I think it's less about multiples from here. It's where you're going to see greater earnings resilience. This is a buzzword that we're going to keep coming back to over the next few months. And it's the value sectors that I think have seen a more realistic earnings picture being painted. Coming off the back of Q3 earnings season, there was obviously a lot of disappointment in some of the big tech names. I think that could continue as we move into next year. The other one really is the dividend payers. It chimes with that value over growth setup where you look at payout ratios today, very, very reasonable, with management still really in catch-up mode, having been forced to pause dividends back in 2020. So I think still a reasonably cautious approach in equities, thinking about ways to keep exposure, but with a slightly more defensive tilt, and then waiting to get more clarity on the size of that downturn and the Fed pause before turning a bit more bullish next year.
And we've seen this run up, of course, in bonds, the bond bull market. And you think that has legs. You say in your notes to us, you're more excited about bonds than you have been in over a decade. I just wonder, there's a lot of misunderstanding about the impacts of QT. To what extent is quantitative tightening a challenge to your optimism around bonds?
I actually think the Bank of England has given us the template for QT, which was that when we saw them step into the market back in September, I think the balance sheet and interest rates are going to be used in quite different ways next year. The balance sheet is more about financial stability. Interest rates are the primary tool for tightening financial conditions and trying to slow this economy down. So it's very difficult to look back in history and say this is how QT works for the market, because we don't really have any good examples of that. But I do think we can say with some confidence that if you start to see QT putting pressure on bonds and you start to see liquidity drying up, I think the central banks will actually be quite quick to pull back from those programs. They need something much bigger to break in the economy to push them away from rate hikes than they need to see in markets to get away from QT.
Okay, so Hugh, you're jazzed about bonds. You see opportunities in the equity market in terms of value. Does that mean that there's no more justifying hiding out in cash?
No, I think now is a good time to be putting money to work, quite frankly, as we look ahead, whether you're looking next year or whether you're looking further out. The valuation adjustment that we've seen this year has been absolutely enormous. I think no one is going to perfectly time the bottom. No one is going to perfectly pick the top in yields from here. But I think you look across bonds and stocks, as you say, and we see plenty of opportunities for investors to be moving off the sidelines and getting cash to work as we push into 2023.
Have we also seen then the death of the dollar's dominance, at least for the time being?
For the dollar, I'd actually be looking outside of the US to path that course next year, because I think it's very difficult to see how the Fed can really weaken the dollar. If the Fed does pause earlier and you end up with a stronger US economy next year, you get back to this idea of growth exceptionalism. If the Fed is forced to keep hiking, you push the US into recession. Global recession then looks very likely indeed, and therefore you get that safe haven flow. So I think to take some of the shine off the dollar, you actually need to see a stronger European picture, a stronger Japanese picture, perhaps with the BOJ coming into play in the spring. Those are the kind of factors I think that you'd need to see the dollar weakening next year.
Yeah, the yen has had quite the run-up, hasn't it, Hugh? Fantastic. Thanks for your analysis, as ever. Hugh Gimber of JP Morgan Asset Management, leaving us with a little bit of optimism. Get that money, get that cash to work as you look to 2023 is the call there from JP Morgan. Right, coming up, Sandra Horsfield, economist at Investec. We'll get more analysis ahead of the non-farm payrolls, the stickiness and the strength within this jobs market. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Mohamed El-Arian, Bloomberg opinion columnist and Queen's College Cambridge president. That's at 9 a.m. Eastern, 2 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Tom McKenzie in London. Anna Edwards is off today. And today is Jobs Friday. All eyes will be on the payrolls report out at 8:30 a.m. Eastern time. The labor market is starting to cool off, but the data may fall short of the turning point that Fed officials are seeking in their battle to beat back inflation. The median estimate says the economy created 200,000 jobs in the month of November. Joining us now for more is Sandra Horsfield, economist at Investec. Sandra, thank you so much for being here. How much softness do you think is going to come through in this labor data?
Probably not quite enough is the answer. Yes, we're looking at a cooling in the labor market. Our own forecast is going for 215,000 expansion. It's obviously slower than the sort of pace of jobs growth we had post the immediate COVID recovery, but it's still not enough. It's still not at the sort of level where we're getting jobs growth in line with population trends. So not quite enough of a cooling, but heading in the right direction at least.
And what do you expect in terms of wages? Because we heard Chairman Powell talking about that specifically when he spoke this week.
I think until we see a bit more of a slowing in the jobs creation and also in particular in firms' appetite to hire, so vacancies, it's hard to see wages really coming down. Remember, we're still dealing with an inflationary environment where consumers haven't been compensated fully for the sort of price rises, nor do we think that will happen. But for now, it's hard to see them backing down on jobs demand whilst labor demand still stays so strong. It will take some time. Hopefully we'll get there.
Is it possible, you think, to have a recession in which we don't see unemployment climb to 5% or more?
I think that's a sort of Goldilocks scenario. Can we cool the labor market just enough to bring wage demand down without going too high on unemployment? It will be a difficult balancing act. It's certainly one that I think policymakers would like to achieve, are trying to achieve. In this current environment, we're starting from a very low unemployment rate. Perhaps if we get more jobs, more people seeking to enter the job market, so more labor force participation coming back, that will help to address this in a nicer fashion than through a whole lot of job losses.
Sandra, do you expect that when we do see the real evidence of a recession, if I should say, although Bloomberg Economics has a model that forecasts a 100% chance of recession next year in the U.S., that the Fed is going to turn around and cut rates in 2023. I've heard more and more people say they expect, the middle to second half of 2023 to include maybe 50 basis points of cuts.
We're in that camp too. We do think that central banks do need to be forward-looking. Monetary policy does act with lags. How long these lags are, always hard to tell. But we have had so much tightening already that it will be very hard to avoid a recession just simply through the weight of the interest rate hikes that we're already getting. So if we think by the second half of next year, we could be looking at recession, then policymakers won't need to be as restrictive in their policy stance as they are now. So it's not so much becoming stimulative, it's less restrictive that they're trying to aim for.
So Sandra, as we face up to that recession and your calls, okay, it's been a relatively mild recession in the US. What is the corporate resilience? Balance sheets are apparently, we're hearing, pretty strong. They've been pretty reserved in terms of capex spending. How does that position the corporates within that environment?
I think corporates everywhere are facing a situation where, for the time being, demand is still being supported by a number of factors. One is households actually still have some of this pent-up savings that they've built up during the COVID pandemic. So in the hits that we've seen, in the inflation hits, there's still a cushion of demand that wouldn't have been there in other times. So that's a helpful factor. Of course, letting go of people at this point is also looking less attractive if it's harder to hire them back in the first place. So with that, there's perhaps more confidence by consumers, by corporates. So the picture isn't quite as gloomy as it might be otherwise. And of course, we have to remember the US is actually a beneficiary from higher gas prices, very much unlike Europe that is paying the bill. They're a net gas exporter. Europe is a net gas importer. It's a different distinction.
So when you think about some of those dynamics, how does China play into that? Is China next year, if it reopens, is it an inflator or a deflator? I'm still not clear on this. What is the biggest impact? Is it an easing of the supply chains, or is it demand and inflation becomes actually more sticky because of China?
It's an excellent question. China, we do think, will head towards reopening gradually. One of the side effects of China's zero COVID policies has been that it has been actually easier for Europe to secure some of the LNG that they couldn't have had otherwise, because it's tied up in long-term contracts to places such as China. If they reopen and use some of that gas themselves, that will make it more difficult for Europe in particular. The US, on the other hand, will probably see more of the sort of general rebalancing of demand. And so for US producers in particular, reopening and unclogging of supply chains will be helpful. We've already seen goods price inflation starting to come down. And as that continues, that is a positive signal.
So essentially what you're saying, Sandra, is that it won't really hurt the U.S. much on the inflation side of the story, but it could hurt Europe through the energy mechanism.
That's right. I think that the energy mechanism does remain front and center in Europe. There's no quick and easy solution. There's no quick way out of this. And I think that's going to play into the picture. So in Europe, we do see a double dip recession, not just this winter, but also next winter in the Eurozone. The UK, probably recession throughout next year because of the energy, in fact. In the US, it's mainly the impact of interest rate rises that we think will be a drag. But that's, as I said, more a question of calibrating the right amount of restrictiveness than trying to over-tighten.
It seems like more of an art even than a science. Sandra, thanks so much for joining us. Sandra Horsfield there of Investec, talking about the difficult job that the Federal Reserve and central banks around the world have. Stay with Bloomberg for full coverage of the U.S. jobs report. Plus, we get John Farrow's interview with Labor Secretary Marty Walsh. That's at 9:45 a.m. New York time, 2:45 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Tom McKenzie with us out of London. Anna Edwards is off today. The chairman of Credit Suisse says the bank has mostly stemmed the huge outflow of client assets that have helped send the shares to a record low. Axel Lehmann spoke exclusively with Bloomberg's Francine Lacqua.
Of course, that's never easy. We have quite a lot of, roughly some 10 key investors. They are long-time investors. They are not pleased where the share price is, of course. But you know, they welcome our plan to transform the company. They have a high belief in the credibility of the management team. So they are standing by, but you know, they are somewhat impatient. They want to see the change. They want to see us executing, and exactly that's what we are doing.
But what was the feedback like? So if I'm a new client, if I'm an old client, why would I put 100 million with all of the uncertainty surrounding Credit Suisse?
No, the feedback is quite astonishing. The clients still like us. They continue to do business with us. So we had basically very few clients really leaving. They might have, you know, in light of those rumors, withdraw, you know, some money from us. But I'm confident. I have a lot of personal discussions with clients. I know from regional management, you know, that money, you know, when we do well, will come back, at least to a significant part.
When do you think the outflows will stop?
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That was the chairman of Credit Suisse speaking exclusively to Bloomberg's Francine Lacqua. So, Matt, you have to stop the outflows. That is the first thing. Then you have to get the inflows back, a second thing. But there's a lot more work we know that Credit Suisse has to do, including cost cutting and reducing its labor force. And we had the Bloomberg reporting yesterday that they're cutting at least a third of their debt sales positions globally. But that's just one part of what ultimately will be thousands of layoffs across the bank.
Yeah, I think it's going to be a tough slog. And considering the fact that wealth management is the biggest Swiss banking business, it's got to be top priority for them, right? It'll be interesting to see what happens with Credit Suisse in terms of the government, whether they come in and help, whether they look for other solutions. There are always sort of parade plots, rumors about tie-ups with UBS. But this is a story that since Archegos and Greensill just continues to disappoint investors. As a result, those shares are so low. Tom, you know, the other thing that's really caught my eye in terms of banking stories today is as we come into bonus season, it looks very depressing. Even traders at Goldman Sachs, who've made more money for the bank than they did last year, in fact, one of the best years that they've had in over a decade, are looking at a possible cut in the low double-digit percentage terms of their bonuses. And Jefferies CEO Dick Handler also sent a letter to employees saying it's going to be a difficult year for compensation.
Yeah, it was a smashing year for traders at Goldman Sachs. And you've got to wonder if executives are taking a gamble, essentially. They think that maybe because of the slowdown, they can push through some of these reduced bonuses because bankers are not going to be looking elsewhere as actively. We'll see if that plays out. Matt.
All right, that's it for Early Edition. Tom, thank you so much for joining us. Bloomberg Surveillance is up next. Lisa, John, and Tom will join Randy Krosner, former Fed governor.